Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Thursday, December 18th, 2025, and we've got a fascinating batch of AI-generated insights to unpack from yesterday's social media discussions.
That's right, Ethan. Our algorithms sifted through a significant volume of posts, flagging quite a few different stocks. The overall market sentiment we're seeing today is definitely a mixed bag. Some clear, promising opportunities, but also a fair share of high-risk scenarios that warrant extreme caution.
All right, let's dive right into it. First up, we're looking at Nebius Group NV, ticker NBIS. Now, we saw a lot of chatter around this one, some really aggressive price targets, with folks talking about $120 to $200, especially with their AI and cloud computing play, and that big Microsoft contract. Users are enthusiastic about a potential rebound, seeing this dip as an opportunity. We've actually rated NBIS as a buy back in November 2025.
Well, Ethan, that enthusiasm needs a reality check when we look at the financials. While the AI Cloud 3.1 launch with Nvidia chips sounds promising for future potential, the current KPIs are quite concerning. We're talking about an earnings per share of negative 0.17 and an operating margin of negative 89%. That's a company losing money on its operations heavily. And let's not forget the debt-to-equity ratio, sitting high at nearly 95%. That's a lot of leverage for a company that isn't profitable. The Microsoft money, some comments suggest, isn't hitting until 2026. The aggressive short-term targets just don't align with these current numbers.
So you're saying despite the optimism and the innovative products, the current picture is what?
For NBIS, based on these financials, we're going to classify this as stay away. It's a downgrade from that buy rating we had in November and consistent with its more recent stay away ratings, primarily due to the severe unprofitability and high debt.
Okay, clear enough. Next, we have Lululemon Athletica Inc., ticker LULU. This is an interesting one, a newcomer to our watch list. We saw posts discussing activist investor Elliott Management building a $1 billion stake and pushing for new leadership. This caused a 5% jump after hours, with folks talking about regretting they missed out.
It's true, an activist investor often signals a catalyst for change. And looking at LULU's KPIs, there's a strong foundation. A PE of 14.36 is quite reasonable for a brand of its caliber, especially with a healthy net profit margin of almost 16% and an excellent return on equity at 41%. Yes, revenue growth has slowed to 7.1%, and the stock is significantly down from its 52-week high of $423, currently at $207. But that activist involvement, potentially addressing the slowing momentum mentioned in some news, could certainly reignite growth and bring those numbers back up. The insider net purchases, though small, are also a positive sign.
So the activist stake, combined with those solid underlying financials, looks promising, right? It seems like a potential turnaround story here.
Absolutely. For LULU, the underlying profitability is strong, and the activist investor provides a clear path for strategic improvement. We're classifying LULU as a buy.
Great start to our buy list. Moving on, let's talk about Alphabet Inc., ticker GOOG. One user boldly asked if they were regarded for thinking GOOG is still undervalued, predicting it could hit 2,300 to 2,500 in the next year or two. That's a massive target.
Well, Ethan, regarded might be an understatement for that prediction. The overwhelming sentiment from the community, and frankly from a realistic KPI perspective, is that $2,300 to $2,500 for GOOG in that time frame is, to put it mildly, bananas. It implies an astronomical market capitalization of $27 to $30 trillion, which is simply not feasible. Even with Google's robust revenue growth of nearly 16% and its strong position in AI and Waymo, its current PE of 30.38 already prices in substantial future growth.
I agree that specific price target is out there, but Google's fundamentals are undeniably strong. They're constantly innovating in AI, Waymo is progressing, and insiders have been net buyers. For a long-term investor, it's still a titan.
It is. So while we're going to say stay away from that aggressively speculative short-term price target, for a grounded long-term investor, Google remains a fundamentally sound company with diversified revenue streams. We can classify it as a cautious buy for those with realistic long-term expectations.
All right, next up, Carvana, ticker CVNA. We saw a user lamenting a $115,000 loss on options, primarily on CVNA puts, warning others not to short meme stocks.
This one screams caution, Ethan. Despite the user's past loss on puts implying the stock went up, the current KPIs for CVNA are incredibly stretched. We're looking at a price-to-earnings ratio over 103 and a price-to-book ratio over 27. That's pricing in perfection and then some. While they do have strong revenue growth at 54% and a fantastic ROE, their net profit margin is quite low at 3.4%. But the biggest red flag for me is the extraordinarily high debt-to-equity ratio of 192, and we've seen significant insider selling, over 750,000 net shares sold in the last 6 months. That's not a signal of confidence from those who know the company best.
So even with the past run-up and strong revenue growth, the risks are too high?
Yes, for CVNA, it's a definitive stay away. The valuation is stretched, the debt is immense, and insiders are divesting.
Let's turn to a favorite, Micron Technology Inc., ticker MU. We saw a lot of good job Micron posts with strong bullish sentiment, anticipating a blowout quarter due to insane RAM prices and the booming AI demand for HBM. Some even talked about seeing 300 soon.
The numbers certainly support a positive outlook here. Micron boasts an impressive revenue growth of 46% and a healthy net profit margin of almost 23%. The PE ratio, while at 30.68, could look even more attractive if those expected blowout earnings materialize, as some users project a forward PE of around 6. But what truly stands out for me is the significant insider buying, over 22% net shares purchased by insiders in the last 6 months. That's a huge vote of confidence.
And with the news of AI demand outstripping supply for memory and competitors raising prices dramatically, Micron seems incredibly well positioned for continued growth.
Agreed, Ethan. For MU, based on its strong fundamentals, growth catalysts, and insider confidence, we're giving it a buy.
All right, up next, Poet Technologies Inc., ticker POET. This one caught a lot of eyes with a post titled The Photonic Solution to the SSD and RAM Shortage, highlighting their innovative optical interposer and Starlight solutions for AI infrastructure. Users were definitely bullish on the tech's potential, with some seeing a 10x return.
I get the excitement around the tech, Ethan, especially with Marvell acquiring Celestial AI, a Poet customer. Their tech could be transformative. However, we have to look at the here and now. Poet currently has a net profit margin of 0.0% and negative earnings per share of 0.7. They're literally not making money on their operations, and their debt-to-equity ratio is extremely high at nearly 11. It's an old company too, not a new startup. While insider buying is exceptionally strong, over 1,000% net shares purchased, it signals high confidence in a future breakthrough, not present profitability.
So the tech is exciting, but the financials are lagging behind.
Precisely. The risks are very high. For Poet, we classify this as a stay away. While it has significant community optimism, its current financial health presents too many red flags for a general investment.
Next, we have Simpson Manufacturing Company Inc., ticker SSD. Now, the post we analyzed was actually about Poet and the broader SSD and RAM shortage for AI.
And that's a crucial distinction, Ethan. While the market for SSDs is booming due to AI, the company, Simpson Manufacturing, ticker SSD, is in a completely different sector. Looking at their KPIs, they have decent profitability with a 14.9% net profit margin and an EPS of 8.09. However, their debt-to-equity ratio is extremely high, over 23. That's a lot of financial leverage. Coupled with insider selling of over 3.5% of total shares, despite a recent analyst target price raise, it raises concerns.
So not the solid-state drive company everyone was discussing for AI, and its own metrics show some red flags.
Exactly. For SSD, the company Simpson Manufacturing, we're going to classify this as a stay away. The high debt and insider selling outweigh the moderate revenue growth and profitability.
Okay, let's talk about Nvidia Corporation, ticker NVDA. We saw a post from someone regretting buying at 180, saying they were providing exit liquidity, but other comments were very bullish, talking about a next leg up for AI stocks and institutional buying.
Nvidia is a prime example of a fundamentally strong company with high market expectations. Their revenue growth is an astonishing 62.5%, and their net profit margin is an incredible 53% with an ROE over 107%.